Good evening, everybody. We're going to start shortly. My name's Ron. You guys can call me Ronald. I made that up tonight. I just want to look at my notes. Always be decisive. Never look indecisive.
Good talk, Ron.
And that's it. Thanks for coming. So, thank you all for coming. This evening is designed to mostly, or not mostly, but primarily to let our clients who we invest money for have a forum to discuss things, to hear what we've been doing and so forth, as well as people who are not clients or just part of our accounting firm and friends and so forth. So thank you for coming. Throughout the night, you can ask questions. Just raise your hand and ask a question. I'll either answer it then, or I might defer it to another part of the presentation. I am not going through the handout, but that's a pretty good resource just to read about us and read about some general investing things. So I'm going to give a short presentation that will probably last 30, 40 minutes without questions, and then I'll open it up to Q&A. I do have more to speak about if people want to hear more, but I think questions are a good idea. Most important, please, if you want a drink or food, just get up, and all night the bar's open. So please don't feel bad to just walk across. If perhaps you could walk around the projector would be okay. And you can go to return visits as well to the bar.
Thank God.
Actually, in the bar, I'll probably end it around 8:30, and we're here till 10. So a few of us last year hung out and had a good time till near closing. So please do the same. I'm going to start with a joke. Just remember, I'm an accountant. So a priest and a rabbi walked into a bar. I'm kidding, Henry. A man was telling his neighbor, hey, he was an older guy, he goes, I just bought a new hearing aid. It cost me $4,000, but it's state-of-the-art. It's perfect. Really? Really, answered the neighbor. What kind is it? And the man responded, 707. I'm not going to read from, my friend Andy taught me this, who's never read from the PowerPoint. And I won't, but I will. This first section is very important to me, and every year I start the handout with a pledge of sorts that we live by at the firm and that I live by. And this is the only section of this presentation that I'll read word for word from that handout. And it goes like this, and it's the way it is. I'm incredibly cognizant as to our duty to our clients. We have an intense responsibility, and we take that responsibility very seriously. We are stewards of your capital, and will always put your portfolio in front of anything else. We are concerned with what we think is best for your portfolio and not what is best for our firm. I think that's very important, and you'll see even through the discussion. Those of you who have been investing with us a long time probably already feel that and know that, but it's good to know. Throughout the portfolio, especially throughout the discussion, especially during questions, I might look through my notes and so forth. I don't remember things, I never have. And I learned that when I was in first grade. I wanted to be in a play, and I think I told you this last year. I wanted to be in a play, and it was Frankenstein, and I couldn't remember the lines. So there goes my acting career. And I'm in a running group, an international running group called the Hash House Harriers, and a few of them are here. And they know that after 10 years, there's a tradition in the Hash House Harriers that there's a ritual and songs are sung, the same songs every week. I've only been doing it 10 years. I can't remember any songs, and they know that. So that's why I'll resort to my notes. There's our building, you know that. Alan Sterinsky, if you'd stand up, please. Alan and I have worked together for 32 years. He runs our accounting and tax firm, and I run the investment management firm. And we have a pretty good thing going. Very enjoyable. Here's the staff, and as I mentioned your name, and I meant to talk about memory. I meant to speak to Donna about this earlier. Donna Gwizendowski. Did I say it right?
No.
And how long have you been married? And I was at your wedding. Stand up. How long have you been married? How long have you?
16.
Trust me, in 16 years I won't know their songs either. We have Denise Acasella, one of our accountants. Stand up, please. Chris Marigi. She's been with us since 1984, and her son Joey is here, and her husband Joe. Good to have them. Debbie Kowalski. She's our newest employee. She just started with us 13 years ago, but she is our newest. Jim Katz, who started with us right out of college. And that's it. All together, we've been together for all of us 183 years, 7 people. That's something else. And we or I really pride ourselves on that, and I enjoy the longevity of our years together. It's a good place to work, and we spend a lot of time there. So I think it's a good place to work. And if your newest employee is been there 13 years, it says something. I'm going to talk about what do we do in the investment management end. We develop portfolios for our clients, and basically the portfolios consist of a diversified basket of stocks. We almost build a mutual fund for our clients. It typically has a value bent to it, meaning it's not super growth. It shouldn't. It typically won't go through the roof, and if things get real bad, it certainly will correct with everything else, but it shouldn't stay in the dumps for perpetuity. We don't have any fixed income in our 4 portfolios, and I'll discuss that later. And one day we might put fixed income in, again, as we always did in the past, up until interest rates became quite low. But at this point we don't. And we'll talk about that, what one should do if they need pure safety. Because certainly anytime you're in common stocks, and that's what we're in, there's an element of risk, no matter what. And when I talk about risk, you could be the best swimmer in the world in the ocean, and if a wave comes and knocks you over, the best swimmer's not going to fight it. They're going to go down with a wave, wait for the water to pass, and then recover to safety. And that's what value investing is. That's how I look at value investing. So if the market dropped 30%, yeah, our portfolios are probably going to go down. Maybe not 30, maybe 25%, but don't join that wave. We only work in a discretionary manner. Most of our portfolios, including my family as well, looks very similar. Because I do research, we research maybe 40 companies and build our portfolios based on that research. We charge 1% of managed assets. So if we have $500,000 of somebody's assets, and it stayed that way all year, we charge $12.50 a quarter, which comes out to $5,000, and it comes directly from the account. You might recognize this picture from the what's called the historic trail in the Watchung Reservation. In my running group, we have a Sunday running group, and we run those trails almost every Sunday. figured woods would be nice for socially responsible investing. Well, we try to practice socially responsible investing. Yet that is very subjective. How is that subjective? I'm totally fine investing in alcohol or cannabis companies, but I wouldn't invest in a tobacco company. Yet, there could be someone else that says, well, cannabis and alcohol impairs the mind, where tobacco doesn't. So someone might be vice versa. That's why I find socially responsible investing very subjective, but it is what it is. Occasionally, throughout my career doing this, there's been certain investments that clients didn't want to own for philosophical reasons. For whatever reason, they might have a distaste for a company, or an industry, or a country, and we'll talk about that. And they'll tell me, well, I just don't want to own this situation. So I'll use an example of Walmart. We used to own Walmart. We don't anymore. People deemed it to be socially irresponsible. You know what? And they are the largest employer in America, and I think 20 years ago they were socially responsible. But now I find them, and I could be wrong, but I find them to be very socially responsible. So I try to educate the client, but at the end of the day, the client might say, I'm sorry, I'm just terribly uncomfortable owning it. And typically, but I'm not going to say typically, but not always, generally, we've always then sold the position. It doesn't happen too often. Examples of that in our current portfolio would be Exxon, cannabis companies, and as I'll discuss later, we have a pretty big allocation to companies that are based in Russia. So if you're ever uncomfortable with it, please talk to us or talk to me. But most clients don't have that position, but don't have that view. But if they do, we respect it, and we certainly respect it. And there are several. This is a slide I include every year. It's called the Rule of 72. It's my favorite financial rule, and basically it tells you how long will it take to double your money. The numerator of the equation is always 72. That's why it's called the Rule of 72. So you take your interest rate. Let's say 6 years is an interest rate. 6 years is a historic rate of return of a 3-month treasury for the last 85 years or 84 years. So if you take 72 divided by 6, you'll double your money in 12 years. Now, in 2008, during the financial crisis, you can see now that the 3-month treasury at the end of September was 1.62%, so 44 years to double your money. In the financial crisis 11 years ago, 0.001, it would have taken 7,200 years. That'd be a nice guarantee. We guarantee you double your money in 7,200 years. We guarantee you'll be here. But then it went way down to 600 years, 637 years in 2015. But it's a great concept, and it's easy to remember, Rule of 72. So 72 divided by the interest rate, or if you want to double your money in 10 years, 72 divided by 10, how much do you have to earn annually? 7.2% annually. Oh, fun information. We have both taxable and tax-deferred accounts. So this next section is only for taxable accounts. We try to be very tax efficient, meaning this year is a great example. This year our returns through this morning were about 16%. But our typical client we'll have next to no capital gains this year, even though there's a 16% return on investment. Last year, I sold a lot of positions because I thought they were overvalued in the beginning of the year. We were having a fantastic year, and then the whole world fell apart in portfolios in the last quarter, and sure enough, so our typical portfolio last year, taxable portfolio, we did better than the S&P. We only lost 3.5%, where the S&P lost 4%, but our capital gains were probably 15 to 20% of a portfolio, and that really hurt. But it was what it was. It was long-term capital gains, but this year we have the exact opposite. But at some point, what do they say? The chicken comes home to roost. If you're a client of ours, or even if not and you have a question on it, just give a call and we can tell you how that's looking for you, or if you need us to try to make adjustments. We're not much more we can adjust this year. I still have some plans of attack to bring in a few losses, but we're pretty much there for many of our accounts, if not all of them. This is just this is in the handout. This is our performance for the last almost 22 years, and then we compare ourselves. We don't feel we should be compared to the S&P 500 because we don't invest in the S&P 500 so much. We really have a diversified base of stocks. A lot of them are more defensive, such as utilities and financials. Sometimes energy could be in that category. But the whole world compares themselves to the S&P 500, so we present it as such. We also present the Vanguard Balanced Index Fund, but we can't be compared to that because we have no fixed income, and a balanced fund is, let's say, 50-50 or 70-30 stocks to bonds. Still not a fair comparison, but we still show it. Well, back in the early 2000s and prior, we always had a big fixed income allocation, so it would have been a good, Vanguard would have been a good benchmark. So what I like to do is I've always looked at the Tweedy Brown Value Fund. They're value investors, we're value investors, and I really like to compare myself to them. They're known as an old and stodgy value mutual fund. So that's that. Now, typically for our portfolios, but not always, when the market is up very big, we aren't as up as much. For example, this year the market's up 21% year to date, we're up 16% year to date. Still pretty good, but typically we're not going to mimic, we're not going to do as well. And on the other side of the coin, typically if the markets fall apart, we won't fall apart as much. I don't know the exact numbers, and I think they're in the handouts, but in the financial crisis, the S&P lost, and I've said this every year, the S&P lost 38%. I was so proud. We only lost 34%. That really stuck. And I had a saying, we suck less. And but the crash of 2000, when the telecoms crashed, we actually made a little bit of money. It was interesting. That's that. I'm assuming many of you or all of you know who this is. And that besides Bruce Springsteen, is my mentor, my hero. That's Warren Buffett, who runs Berkshire Hathaway. I seem to have a lot of the same philosophies. I've actually written him a letter, and he's written back to me many years ago. That was pretty neat. As my wife knows, my wife Kim knows, I go through the mail. Basically, I go through the mail, I throw stuff out before even opening it, junk mail. And one day I threw out all my mail without opening it, and about 2 hours later I'm like, did I just see something did I throw something out from Nebraska? I take it out of the garbage. It was a letter from Warren Buffett. A side note, Kim has put an ixnay, a kibosh on me throwing out, I can't throw out anything with her name, you know, like, come to this financial seminar. I can't, you know, ABC, High Commission Annuity Fund. Don't throw it out. I don't. most of what I do is read, and read. I read 90% of the day. I read financial reports, company reports, analyst reports, newspapers, and I just fill myself with knowledge, and frankly, that knowledge is embedded into our clients' portfolios. We own a lot of companies right now, but I know most of those companies quite well. Not all of them, and I can go through specifics if you ask later on. But many of our companies I know like the back of my hand, and that's probably more than 80% of the companies we own. Probably 90 to 95% of the companies I know them very well.
Does that, Ronald,
Yes, owner.
does that include the Russian companies? You know them very well?
Yes. Yes, I believe I do. Yeah, we'll get it. There's going to be a whole discussion. There will be a discussion on Russia. When you look at your portfolio, the typical dividend is about 3%. So if you have $100,000, you're typically going to earn $3,000 this year on that portfolio. That's a really good number, and I've always used. I always wanted our dividend yield. I feel very comfortable because there's a margin of safety. You'll always get paid the dividend, typically. That's why I call it expected dividend yield. And if I lose anybody, please ask a question if I'm confusing anybody. So with and I like to go against the 5-year Treasury, and the 5-year Treasury now is at 1.57%. So I'd be very comfortable at 67% of that. Let's say our dividend yield would be 1 for rounding purposes. If we had a dividend yield of 1%, I'd feel comfortable. Well, our dividend yield is 3%, which is almost 200%, 2 times the 5-year Treasury rate. So I feel real comfortable with that. It gives us a margin of safety, I believe. And this is the widest gap I've ever experienced, where we're almost 2 times as much in dividends as the 5-year Treasury. And we don't have any crazy dividend payers. I guess part of that, and I'll discuss later, is our Russian investments, which do pay a high dividend with a lot of financial safety if, and we'll talk about that, their numbers are accurate, which I believe they are. Last year I was quite happy with it, and I believe we were like 90% of the 5-year rate. So still a margin of safety, but not, still over 67%. And 67% is a goal. It doesn't necessarily mean it will be achieved. I'm gonna have a little water. This is my lucky bottle. It really is. This is our allocation. Everything I'm talking about is as of September 30th. Things aren't much different since September 30th. We have eliminated 1 or 2 positions, and our portfolio is at 16%. I forget what it was here, but pretty much the same. So you could see how we're diversified in various assets. Power and energy is a huge percentage. Well, you see cannabis is 10% of our portfolio. Half of that is in a company called Scott's Miracle-Gro, so it's not as concerning as it seems. Scott's Miracle-Gro is a conglomerate. You all know Scott's products, and I'll talk about that later. And it's also presented in the handout I gave you. I presented some of our larger holdings and the reasons we own them. I've put all our holdings together as of September 30th, and Andy, I think you might have mentioned to me once that this is a magic number. We have 42 positions. Is that the magic number? You don't remember. I remember once you told me on a run, but so we have 42 positions. I'd like to have a lot more. Ideally, I'd like to have 10 or 20 positions, but we don't now, and we really haven't, but ideally that's what I'd like to have. So we have 42 holdings. 10 of those holdings make up 54% of our total assets. 20 of the holdings, 20 of them make up 81% of our assets. So the rest, the other 20%, in 22 companies, are stragglers. We don't have as much conviction, so we don't have as big an allocation. Our position size of any company reflects our confidence in our research as well as in their business, the price of the company, of what we own it at, or what it is today, not what we own it at, which is somewhat irrelevant. But our conviction is based on how strong we feel on that situation. Good example, and I'll talk later, would be Gazprom. It's a 10% position, maybe even a little more now. I don't have that in front of me. Part of that is because it's really gone way up in price this year. The other part is I still think it's incredibly undervalued. But I do research it all the time, and if I had to get out, we'd get out. I don't expect such. So even though we have 42 companies, which historically has not been traditional for us, our top 20 companies, 81%, it's always been about the same. So pretty good with that. We also like to buy and hold. We don't sell much at all. Our portfolio turnover, meaning the percentage of value of what you sell, this year projected and the last 5 years has been 32%. It basically means our typical company we own for 3 years. But if you look in the portfolio, our large holdings, you'll see how long we've owned these companies. So we've owned many for many years. Now, to talk about our Russian investments. We have about a 15% allocation to Russia. Vladimir Putin has been in charge of Russia since, I think, about 24, it'll be 24 years, about 20 years, I'm sorry, 20 years. I could be wrong on that. His popularity used to be huge, like 90%. It's really decreased quite a bit, and I do believe you can trust the numbers, but his popularity has decreased incredibly. I think for several reasons. Maybe the internet and the Russians see more of what's going on in the world. America's, oh boy, the term escapes me, the sanctions. The sanctions have hurt his popularity, as well as opposition is growing. Now, Russia has only been a democracy for 30 years, so think about our country, 60 years, or 60 or 90 years after we started, we had a civil war, or 80 years. So I consider Russia an evolving democracy. People laugh. I know my views are terribly contrarian. I do study Russia extensively. I do believe their numbers are as they say. I read several newspapers, one daily and one weekly. I've never seen necessarily lies. I compare the Moscow Times to the Washington Post or the Wall Street Journal. There's something called RT. It really has no name. It used to be called Russia Today or the Russia Times, but they're specifically called RT. The other day I was reading about Canada and their voting. And I'm like, wow, this is not accurate. This is not accurate. I read the headline. The headline I felt wasn't accurate. I was surprised that I finally saw something. I read the story, and then I read all the other papers, and it was accurate. But the wording made it seem a little sensational. That was that. Russia's primary. I'm going to tell another joke because normally we only have 30 people here, so now we have 60. So I felt I should do 2 jokes. So Putin's main opposition party, and there's so much to this, so if you want to discuss it, we can. But the main opposition is a man called Alexei Navalny. A young man, he's in the news all the time, he's always being thrown in jail. A lot of times he's being thrown in jail because he knows he's breaking the law, but it is giving him great press. Well, remember, his name is Alexei Navalny. And there's a joke in Russia, and I told my barber this, and he doesn't like Russia. He doesn't like to hear about Russia, but he loved this joke because he's from Russia. So his name's Alexei Navalny, and if in the winter you write the name Navalny in a snowbank in Russia, that thing is gone. Half an hour, that's gone. If you write the name Putin in the same snowbank, it'll stay till his term is over in 2024. And that'll be, Russia allows two-term presidents, and in 2024 he'll finish, Putin will finish his fourth term. Well, actually the reason being is, it's always confused me, but Russia, unlike the United States, you're allowed 2 terms and that's it. That's it. In Russia, you're allowed 2 consecutive terms. So you could be in there for 8 years, or actually I think it's 12 years, 6 and 6, take off, and then go back in.
What he did in 2008.
Yes?
Putin was 2008. Then
Probably to 14, then he became prime.
Model Prime Minister.
Yeah.
To
Well, that's how he skirts it. That's how he skirts it.
and then came back in 12.
Very good. Yep. So maybe he'll take off a year in 2024. But he's getting older, man. He's no kid anymore. He's 60. He's 62, I believe, 63. Our basic investment thesis for Russia, as well as most of our when we buy heavily, is we like to buy in what John Templeton called blood in the streets scenario. When things couldn't be worse, that's very often when we're buying. And we tell new clients, and we've always told new clients this, when you join us, your portfolio we're buying things that are getting pummeled on Wall Street often. So when you join us, the stock doesn't say, "Oh, Redfield just bought us, let's go up." No, it could take time. Once the more portfolios become mature, it starts showing its value. And I think Gazprom is certainly starting to show its value, as well as pays, if I remember correctly, I don't know my notes in front of me, a 7% annual dividend. That's all I'm going to say on Russia. This is very important. The only true safety one can get, if you want pure safety, you can invest in either CDs or treasuries. That's it. You can see the CD rates of 1 year is 1.6%, of 5 years 2%, and it's just amazing how much they've gone down. It's just amazing. But if someone says, "Oh, I can get you a 6% guaranteed 5-year return," how can you give a 5-year return if the 5 years Treasury is paying 1.6%? How could you give a 5-year return with safety of 6%? Well, maybe you can, but it's not with safety. They might sell it as safety, they might say it's safety, but it's not. Look at our portfolios. We've averaged probably 10, 11%, I'd have to look at the thing, but over the last 4 or 5 years, annually. But it's not guaranteed. It's not guaranteed safety. So if you want guaranteed safety, you must own either CDs or treasuries. I prefer CDs because they pay a little bit higher of a rate, and they are FDIC insured. We started this year to offer CD accounts to our clients. And this goes to show you how we're looking out for our client and not for us. We don't make a penny on CDs. If you have a CD account of $100,000, you get charged zero by us, and you get a real good rate, probably a better rate than you can get at the banks and so forth. So feel comfortable. If anybody wants pure safety, talk to me about it. We could set up an account for that. We do require that a separate account be set up that only consists of CDs. We still are only discretionary about it, and all we need from you to know from you is how much the funding will be and when will you need the money. Because we don't want to buy a CD and then have you sell it early, because then you're at the mercy of the market and you'll get ripped off. It's not what we want to do. If you don't go to us for a CD, go to a bank. But historically, more times than not, I've found people go to a bank for a CD and then they end up with a product that pays the 5 or 6%, but it's not safety. It's not the same safety. So you really have to be concerned with that. If you go to a bank for a CD, get a CD. Don't buy any of their products. That's my thought. You can see here the 5-year CD is 2%. A year ago at the conference, it was 3.5%. Wow, what a drop. We were buying CDs for clients this year, 2.9%, and I bought one for, I'm very firm on confidentiality, so I won't mention I bought it for my daughter. But I bought her a CD yesterday at 1.6%. That's just crazy, but it was a 3-month. And frankly, the 3 years were going for pretty much the same rate. Very, very tough out there, especially for retirees or people on a fixed income. We haven't had, we have terribly low interest rates and we have not had inflation. Throw inflation into the picture, it could be quite a whammy. A lot of my friends here, we have kids the same age, they've never had inflation. Look, a lot of us remember inflation from the 70s when there were lines at the gas tanks and gas went way up and things got expensive and meat got expensive. I remember in my house we were eating chicken. They haven't seen that. And one day it might raise its head. And I'm always looking at that. One of my big concerns, and this is evident in many of our portfolios that allow for shorting, one of my big concerns is the proliferation of lower credit rate, higher risk credit loans being given to corporations. If you remember the old days, Microsoft, Exxon, Johnson & Johnson, General Electric, AAA, ADP, AAA. Well, now General Electric's hovering, it's very close to being non-investment grade. There's different tiers of quality. You have AAA, which is the utmost of safety. Then you have upper grade paper, medium grade, medium investment grade, and lowest investment grade. And that's what BBB is, and it goes in 3 different sections. BBB minus, which is a step above high yield junk, and so forth. So you can see most of the issuances and paper out there is BBB rated, and that's concerning for me. When I used to buy bonds, we wanted AA or better, and now it's and GE, which is potentially distressed, is paying 4.5% for like 10-year paper. That's not a I don't know, that's not enough a return for a potentially junk bond. And if they get downgraded to junk, what will happen to the bond market that the credit quality bond funds won't be able to own it, and the prices can really, I think, get whacked. And that's part of our investment. And there have been no defaults yet, very little defaults on BBB. If that starts. So our thesis is if there's any type of shock to the system, be it a normal course recession, It's as normal as a freezing winter in Michigan, a recession, or if there's rising interest rates. That could seriously hit bond prices, and there's so much passive investing in bonds right now with ETFs and so forth. So we've been unsuccessful, but not by much so far. We do have short positions in high yield bonds. Also having that short position, our taxable accounts our returns are somewhat a little bit lower than our tax deferred accounts this year, primarily because of the short position. But on the other hand, the short position, if things get funky, should increase in price, so it offers a little bit of a hedge. I like that a lot. And unless there's questions, that's my speech. Unless you want me to go further, there's another topic I can talk about, which is something I'm very well versed in, is investing in cannabis. But you all might have questions on that. And so at this point, I think I'll open it up to questions. Yes, Steve, and it's Steve and Deb's anniversary today. So romantic.
It's our anniversary dinner.
Oh. That
Saved me a lot of money, right?
That reminds me, I have a song for you guys. Yes, Steve.
My question is, you use the term guaranteed rate of return, and I've always been curious about that. So if I invest in something at a guaranteed rate, and at the end of a term of time it underperforms that guarantee, by definition, somebody owes me the difference, right? Or else it's not a guarantee. So what is guaranteed rate exactly?
Okay, so I'm going to give you a word, an answer that I'm very famous for, the word perhaps. Look, if you buy a CD, if you buy a 5-year CD at 2%, for argument's sake, you're guaranteed at the end of the 5 years to get your principal back, and you'll get your 2% every year or every 6 months. That's a guarantee. That's your guaranteed rate. If the bank folds, it's FDIC government guaranteed. So you're going to get that money back. Now, if you buy an investment product from ABC annuity company, well, what if they're not around? What if something happens to them? So the guarantee may or may not be there. You have to read the fine print. Steve, we sell no products. We're meat and potatoes. What you see is what you get. It's very clear cut what you're investing in. And I was telling someone before, I forget who, today, we've had clients ask us, hey, would you guarantee us results? And I clearly, we're supposed to be, knock on wood. We're supposed to be, investment advisors are supposed to be audited by the SEC or the government every 5 years. And we were just audited just recently, right before, 2 years before Debbie joined us in 2006. And they said, I was telling my friend here who's a compliance in the investment world. And the SEC said, do you guarantee results? And no joke, this is what I said. I go, we do. She looked, wow. I'm like, we guarantee if you join us, you'll make money, lose money, or break even. She's like, that is true. So she liked that. I hope I answered your question.
So there's no guarantee?
There is a guarantee. If you buy a treasury, you're backed by the U.S. government. If you buy a CD, you're guaranteed. Those are the only two investments I can think of that you're guaranteed. If you buy a New Jersey tax-free bond, I don't know if that's guaranteed. What if we get downgraded? There's a lot of stress in the systems, and New Jersey is not the strongest financially of states. But there is guarantees as long as we have a financial system in CDs, as long as it's at the FDIC limit or lower, or the U.S. government, U.S. Treasuries, as long as U.S. Treasury exists.
Got it. Thanks.
Yes?
Can I ask you about China?
Jeff? Yes.
What's your feeling?
I don't follow it much. I do have my eye on it, but my hands are full, and right now I'm avoiding it. I would love to own it. They're a powerhouse. Same with India. Frankly, same with Russia. And Russia's getting very strong this last month because of the Middle East, and so I don't know. I don't know exactly. Other questions? Yeah, yes, Cheryl.
You opened the floor to questions about cannabis, and I want to pinpoint on Can Trust. I noticed that you sold some recently, and I'm wondering why you didn't dump the whole thing.
Okay.
Because of their fraud situation.
Yes. Let me talk about CanTrust. CanTrust is spelled C-A-N-N, capital T-R-U-S-T, CanTrust, Can for cannabis. They were one of, if I recall correctly, they were the largest medical marijuana company in Canada. Projected to do $500 to $600 million in revenues in a couple of years. Remember, a little over a year ago, Canada's been medically legal for years, but only for a year now it's been legal recreationally. And for a week and one day, there's actually been, now Canada finally allows extracts and edibles. That just happened. But they still won't be available for a few months. But the first license was just given out today to one of our companies, I forget which. But to get to your question, and they're CanTrust. I renamed them Can't Trust. This company is ready to do $500 million in revenues, and they have grow rooms, and they got all licensed. But it turns out that they were growing product out of these grow rooms before they were licensed. And the product they were selling was maybe $20, $30 million. It made no sense that they were playing games on their future livelihood. And they got caught. They basically faked out Health Canada, and they made it look like the grow rooms were empty where they weren't. And they got caught. And the other day, they finally settled, and it was a good thing because they could start fresh. They have to dispose of $80 million of inventory. Now to answer your question, why we sold it. Why we sold only a little. Because it is a company I think at this price I'd rather ride it to zero. I think they could do okay. If you'll notice, 31 days ago we bought the same amount of shares that we sold for you. The reason being is you have to wait 30 days for what's called a wash sale. So we wanted to take the loss, but we don't want to sell the position, so we increased the position and then sold it, and that's why. And we got a nice, that's part of where our capital losses came from. Now there's another company that I wanted to do the same thing with, but some news has come out on them, not fraud, nothing like that, but we sold them off. And we're in the process of selling it off. I prefer not to mention the name because we still have a few shares left. I think that answers, right?
Right. So I'm curious what it is that you've read that gives you confidence that CanTrust is going to be able to turn it around.
I've read nothing, and there's no material on it. Basically, it's gone from, I'd have to look at our average cost, but let's say $8 a share to $1 and change. At this point, it's just an option. There's nothing to it. I'd rather not sell it for $1. There's no information that anyone can possibly have to say it will be successful or not. It's just not out there. But if you notice, it's a very small part of the portfolio.
No, I understand. I was just curious if you had seen something that gave you some level of confidence that they were going to, after they got rid of, I guess, their top people, that there was something that you had seen that gave you confidence that maybe they'd be able to turn
No,
the tide.
I have zero confidence, zero. I don't know. I'm guessing they'll be around. They're huge. Their infrastructure is huge, and they're huge. They have to start over. And the stock went way up when the news came out that they had to get rid of all their inventory, just destroy it, because now they have the opportunity to start again. And they're a big company with a big infrastructure that I don't think will stop, but you never know. You just don't know. Well, another thing with them is they got funding. They got funding, and what if the people that gave them money through loans and so forth say, well, you got fraud, give us back, we're clawing back all our money. There's a lot of risk to it, and that's reflected in in the allocation. There's another company we own called Afria. Afria, I followed forever. We didn't own it. They were accused of fraud about a year ago by a short selling group, and it sounded legitimate. Very well could be legitimate. But the price of Afria went down like 80%. And I looked at the company and I said, you know what? We'll put a small allocation. If it goes bust, it goes bust, but I think it really could be something. And what they ended up doing was they fired their people. They brought in as a CEO, temporary CEO, a man named Irwin Simon, who started Yum Brands, which is now Hain Food Group. And he's now on the board of directors, is a former, I don't know if it's his CEO, but someone very big of Whole Food Markets. They have a nice stable of directors and so forth, and I think they could really become something. But time will tell. And they're also selling. I mean, they will sell probably $600 to $700 million Canadian the next fiscal year. So they're the company with the largest. I guess they're the second largest cannabis-related revenue company I'm familiar with. The largest being Scotts Miracle-Gro, which Scotts is one of our bigger positions, a top 10 holding. I liked it a lot more at much cheaper prices. But if you're going to grow cannabis indoors or in a greenhouse, you have to have an infrastructure of lights, of fans, of all this different equipment, filtration. They are the 800-pound, Scotts Miracle-Gro is the 800-pound gorilla. And what really got me into buying them was every analyst I spoke with, including cannabis analysts, said, yeah, it's a speck, no matter how big they get, it's a speck of dust compared to all their revenues. Well, we project within a year or two, and it's in the pamphlet, I'm going by memory, so I could be wrong on this, that their cannabis-related revenues will be 23% of their total revenues. That's hardly a speck. As an accountant, working for a former accountant, we were always told 5% is material. 23% is certainly material. And even when they were saying this, it was at 10 or 12%, so it wasn't never immaterial. That's where that is. Yes, Mr. LeBeau.
Ron, two big holdings you have are Citigroup and number 10 is ExxonMobil. Can you speak to both of those? I know ExxonMobil has almost a 5% dividend. But one of them hasn't done anything. They really haven't diversified. Energy is kind of stagnant. And then I feel the same way about Citicorp, but it's just my opinion. Tell me your thoughts.
It's interesting. How do you feel Exxon hasn't diversified?
Well, I know they get into plastics and packaging.
Well, chemicals, yeah. But it's funny because they're not just an oil company. They're the largest natural gas company in the U.S. And they're actually the second largest gas and oil company in the world behind Gazprom. Brian, to answer your question there is, interesting you say that. Are they a top 10 holding? They're number 10, okay. Years ago, we started positions in Walmart and Microsoft. Those are two companies that really just, and people would normally ask the same question: why do you own them? They've been down in the dumps forever. Well, it doesn't mean the rear view mirror isn't necessarily the front view mirror. So the reason we own Exxon is they do pay a nice dividend. They're still very highly rated as a credit. Their multiples are fair. They're diversified, being in oil, gas, as well as chemicals. They do upstream, they do downstream, refining, and so forth. So I like the diversified mix with safety as well as with a dividend. End of the day, it's certainly, I guess with the dividend, it's probably close to break even since we've owned it. That's why we own that. Citigroup has done quite well. Citigroup, one of the bigger banks in the world, a big international presence. and this is where I'm going to refer to my notes. I don't want to say anything wrong. And this is it's written up in our book in the booklet as well. I like to value banks based on their price-earnings ratio, if you know what that means. How much are you paying versus what they're earning? Their price-earnings ratio is one of the lowest in the industry. Their price to book value means they have $1 in their pocket. They're selling for, I believe, 80 or 90 cents on that. Yeah, the price to book is around 80 or 90 cents on the dollar. So there's built-in safety there, and they're growing, and they're strong, and their dividend is doing well. And a lot of our themes for the banks is that people are still scared because of the financial crisis. But the health of the banks, it's a different game from 2007. These are healthy banks. They're not as leveraged. And that's still going on where because of such low interest rates, their net interest margin is very small. If interest rates rise, and I think they will at some point, they'll do even better. So that's why we like Citigroup. I'd have to look at our numbers, but I think Citigroup's been one of our better performers. But I'd have to refer to the notes. Yeah. Just bear with me 1 second there. Our average price is 43, and now it's right around 70. And it was also our 8th largest gain so far this year with a 36% return. Now let's see if Exxon's in the lowest. Hey, what's interesting about our gains on page 23, our 10 largest gains make up 30% of our portfolio right now. Our 10 largest losses make up 12% of our portfolio. I like that ratio. Okay, other questions? Yes, Chris.
I had one, but it's not about the portfolio. But
I'm not going to answer that.
no, I was looking at today. It trades at an 8 to 10% discount to NAV, and it yields like 4.1, 4.5%. Two positions out of that. It's federally tax-free, but it's a closed-end fund. Have you ever utilized those?
Yes. Yes, I in my day I was a specialist in closed ends for sure. Kim, do you?
I'm loving
Kim?
it.
Kim's father, who died in 1994, introduced me to closed end funds.
Aren't they great?
What a great concept.
They're wonderful.
I could go on forever. We have a really cool section on our website on closed-end funds.
Really?
And we have permission. The problem I have with closed-end funds is back in the late 90s, mid to late 90s, and early 2000s. Mid to late 90s. Closed-end funds could be invested in double A paper, very safe, and they'd be selling at 85 cents on the dollar. That made no sense, so we'd buy it at a big discount. There were some global country funds that were selling at 70 cents on the dollar. Great discounts. I think you mentioned 8% discount.
Yeah, 8 to 10%.
It's not enough for me. There's no liquidity. It's
You like
tough to
bigger
get
than
out
that?
of. What's that?
Well, what percentage discount do you look for?
Well, you'd have to look at there's more to it, just the discount. You'd have to look at
Yeah.
what's their, if they sell anything, what's the built-in capital gains and so forth. There's a lot to look at there. I used to like to see 25%, 30% discounts. You don't see that anymore.
I haven't seen
You don't
that.
see it. I haven't seen them for years, so that's why I haven't touched a closed end for a long time. And I remember we once during the telecom bubble, where everybody's buying telecom stocks that eventually crashed, we were able to buy closed ends AAAs that had a less than a year to go at an annualized return of 15% for near treasuries. That was crazy. That was a no-brainer. That was really, there's not too many no-brainers, but that was one of them. there used to be a man named Marty Zweig
Yes.
Kim knows him as well. He said, I brought you in here, I mentioned your dad. Chris mentioned closed-end funds. Chris mentioned closed-end funds, and your dad taught me about that.
Yeah, didn't he had the, Z, whatever, what was it? He had a closed end.
Yes, he had this Zweig fund and Zweig total return.
Yeah.
And I used to go to his
I love it.
conference his annual meeting every year. I love talking to him. I love watching him on Wall Street Week.
He's
He was
always
always pained. He was
Always nervous.
He was so good. He's been dead for about 10 years now,
I
I'd say. But I remember when he was bought out, I believe their company was bought out by Franklin, and they were forced to pay a dividend. And he only wanted to pay, if you earn it, I'll pay it. Well, they wanted to go into principal, and that was the mandate. And I asked him if his new boss is sitting next to him, if push comes to shove, and would you be paying a dividend? And he's like, wow, that's a really good question. I just don't feel comfortable answering that, giving you my honest answer. But, it was very interesting to hear that. He was quite a man. He was also, he has the term, don't fight the Fed. And before he died, I was able to speak to him and say, hey, you say if interest rates go up twice, get out. Well, it just happened. He goes, well, interest rates are so low right now, I think that only counts if it's 6% or higher. And that's when interest rates were 4%, not 1%, so very interesting. He was great. And I also remember at one of his meetings, James Rogers, do you guys know him? Jimmy Rogers, he did a book on, he traveled the world on his Harley, I think it was, with his wife, and wrote a book called Investment Biker. Well, he's still on TV a bit, I haven't seen him in a while, but he's famous for his bow ties. And I remember, I wear bow ties on occasion, and I remember I'm waiting online at Brooks Brothers, and I'm reading a gentleman likes to wear, and I see, oh, you don't wear a bow tie with a button-down shirt. Apparently a gentleman don't do that. I didn't know that. I asked the guy at Brooks Brothers, he's like, oh, that's a bunch of BS. But so I'm in the bathroom at his Zweig meeting, and I see Mr. Rogers. I'm like, hey, do you mind if I ask you something? No offense, you're always wearing bow ties, and I read this, and he's like, that's a bunch of, he just went off. That's ridiculous. He was putting on his bow tie and a button-down shirt. To this day, I don't know the answer, but it's very funny. Since that day on TV, I've never seen him with a bow tie and a button-down shirt. That's so crazy. But that's the way it is. Yeah. He's all right. He's a crazy man. And I was telling Zweig, your dad used to love watching Zweig. Her dad would have been, this has been quite an event in the family. I don't know if Kim knows. Well, her father would have been 90 yesterday. But he died in 1994, and we had a pretty cool relationship. And I do remember around I'm not exact here, probably around 354 months ago, we had lunch where I asked him if I could marry his daughter, and he was, yeah, of course. And he goes, what if I say no? I go, yes, I don't, That was pretty cool. There was just an audio put out of my father-in-law yesterday where remember, he would have been 90, yesterday he would have been 90. When he was 20, he did this audio, and he discussed the difficulty and the health hazards of being a president and all one has to go through. And he had some really cool things to say, and I would love to talk about what he said today. It was just incredible, really good. But anyway, I wish he was around so you could see, Anyway, he told me about closed ends. He was a cool man. Alan, is this a layup you asked? You want me to throw you, not to break confidence, but because you want me to throw you a softball? No, I don't want a softball. Let's hear it.
Okay, can you explain First Solar and the average annual sales for the last 25 years?
Yes.
Okay.
See me offline on that.
It's up 37%. Could you just explain what the cause of that and what they actually do specifically? Aside from maybe the obvious.
No, it's actually, who said the obvious? You?
Yeah.
No, it's not as obvious.
Okay.
Their earnings came out tonight, not so great, but not awful. Not awful. Intel came out with good earnings. Basically, First Solar, they are, it isn't so obvious because their basic business is they build plants and operate plants for utility companies. So it's not like they're selling, it's not like Solar City where they're selling for the roof of your house. They're supplying, when a utility company, and Rob works for them, I don't know if you're familiar, for solar, when a utility company has part of their energy delivery being, or electricity delivery being from solar, they're the ones that supply the infrastructure for that utility. One of the reasons we own First Solar and always owned it is because the Walton family owns over 30% of it. A growing industry. We originally bought them, I think, at a much lower price. Because they're misunderstood. Their projects are so big that they can't even provide guidance because they're just so big. So if a project's supposed to be done in April and maybe finished then in November, it's what's called lumpy. So there's very often it will get, or it used to be, maybe not so much anymore, but hurt after it reported earnings, and we would be buyers at that point. But basically they're supplying the infrastructure to utility companies, not to consumers. Does that answer, Alan?
Sort of. So they're up 37%. What, is that just random or is it?
Well, when a company is up year to date, it's very, it's a lot of noise. We're long-term investors. I will say, this is before evaluating the earnings that came out today, but typically if it was under $50, we buy it, consider buying it, If it was over 80, we consider selling it. And that brings me to, well, we'll go on, I'll talk further. But why is it up 37%? Who knows? Sector related? I don't know. It's very difficult to tell. They also have a new series coming out, new modules and some tax surcharges didn't go, they got taken away, so there's various reasons, but I don't know why they're up 37% to date. That's good?
Yeah, that's good.
I have to be honest, that was not a softball. And of all the years giving a question, that could have been the most difficult question I've heard. I'm going to deviate a little bit. Every company we own, and I think I've talked about this in the past, I have a color-coded chart I have that actually my son Adam developed for me. And I know, on that chart, I know what price I would consider, and I really emphasize the word consider, and it's always a moving target and I'm constantly changing it. What I would buy it at, what I would consider selling at. And we have that for every company. And part of that, we sold Microsoft. Kind of looking back, part of me says I wish I didn't. Well, of course, it's up 10 points since we sold it, but you can't look back. You don't know the future when you're doing something. But and interesting enough, even though the market is, people are very concerned, and I'm certainly concerned. We have. My chart is yellow for green for buying and red for selling. My chart is mostly green. It's crazy that there's so few things I wouldn't buy on it. And often those are the ones that we would sell. There is a company we own or used to own called Castle Brands that just got bought out by a liquor conglomerate. We wanted to own them, but we couldn't own them. The stock got taken from us because they were bought out at a pretty good price. And that also is a gain, taxable gain for our accounts, but reflected in already what I said about the tax situation. Yes, Myrna?
I was going to ask you to comment on two of the largest holdings, Alaska Air and AbbVie. Alaska Air was in 2017 and AbbVie last year.
I'm sorry, what did you say? Alaska Air was?
Alaska Air was the first one.
No, but what's your question?
What's your forecast for that?
You know,
Or you don't want to?
no, I'd certainly tell you. Okay, Alaska Air, and they came out with earnings today that were very good as well after the bell. I haven't absorbed them all, but we don't care about quarter to quarter. We really don't. Alaska Air, and how I became acquainted with them is we flew Alaska Air once, and I'm like, this is a good company. I really enjoyed it, and I looked at their stock price, and it was about 100 a share. I'm like, wow, I can't. I looked at it. I didn't. It just wasn't $100 stock to me. There's no way. Well, it went down to the 60 or the 50s, and we bought it. That's it. Now, once again, this is not updated for new earnings, but we would consider selling it at $110 a share, quite a bit higher than the $68 it's at now. And the 68 is a lot higher than it was not too long ago. Maybe even.
They bought 2 other airlines, though, since, I don't know, since then. In the last.
No, they not in the last year. About 3 years ago, they bought Horizon and they bought Virgin Atlantic.
It was Virgin Atlantic.
Yeah.
I'm losing track now.
Yeah, it's been a while. It's not. I mean, they owned it before we owned it, and we've owned it. I'd have to look at once again in the thing. You have it there the year we bought it, and they bought it before we bought it. And the other one was AbbVie, and AbbVie is a, of course, a big pharmaceutical company. They're merging with another big holding of ours, Allergan. We bought AbbVie after they bought out. I wanted to buy Allergan. We were ready to pounce on more Allergan. I'm ready. I go into the office and boom, they announce a buyout. The stock goes up. I'm like, shoot, we can't buy that. But the buyout was AbbVie, a company we already owned. I did my research and we bought more of it. But we will lose our Allergan shares because it'll hopefully absorb into AbbVie. But they're a pretty well diversified pharmaceutical company, and that's why we own them. And we'd like to own more pharma. But right now, there were a few I had my eye on, but the price has gone up, and perhaps we'll get an opportunity again, perhaps not. Yes, Neil?
I saw that you, what a company called Supreme Cannabis. I'd like to ask 2 questions. One, what did you see in that company? And 2, is there a surcharge to buy that stock? Was it foreign stock?
There's no surcharge. When we buy a stock up until September 30th, there was a $6.95 commission for each trade, be it if you bought 1 share or 1,000 shares, $6.95. That's been eliminated. There's no more charge for that. All the cannabis stocks basically are Canadian companies. There is no surcharge at all for buying a Canadian company. We're buying the OTC bulletin board stock. Excuse me. Even though the commissions are inconsequential, so now it's 0 versus $6.95. You still have, for the OTC bulletin board stocks, there's still a $6.95 commission, but that exists. So Supreme, probably buy at these levels. The whole sector has gotten destroyed. I could discuss that, why I think the sector's gotten destroyed. So basically, Supreme, like all of our cannabis investments, their current revenues, none of them are large yet except Afria, because they're now building their infrastructure, and hopefully now that the infrastructure will be built, they could sell hundreds of millions of dollars per year of cannabis, legally, in Canada only. And that's changing as well. So that's our thesis, is that we own a major cannabis company that's licensed in Canada. Their forte is high-grade cannabis, which I guess people might have a preference for. And it's a price that we think is real good should their business model turn out. If their business model, if they don't start selling, we have them projecting hopefully $200 million of revenues in 2021. Well, if it's 60 million in 2021, it probably won't be a good investment. If it's 200 million and they actually achieve the results or somewhere near that, it should be a very good investment. But the cannabis companies across the board basically have gotten hit for the last 6 months. But it is a company we would own in new portfolios for sure. My last research on it was October 7th, so pretty darn recent. Let's say we own half a percent of one's portfolio is in that typically. So if you have a $100,000 portfolio, you'll have $500 worth of Supreme. And if our allocation if our conviction was much higher, we'd own $5,000 in a $100,000 portfolio, but we don't. So we don't have that conviction. So it becomes a small holding. But I do think cannabis will be a new paradigm. I think it's a future worldwide $200 billion industry. I think there'll be worldwide legalization. Mexico is very close to legalizing it, especially in light of some recent events. They think it will be able to combat the cartel with legalization. Canada, it's still illegal here in the United States, even though 11 states have it recreationally legal and 33 states have it medically legal and recreationally. So over half of the United States has some form of legalized cannabis, but federally it's still illegal. Well, that is being worked on by the government, and I wouldn't be surprised to see it legal within a couple of years, federally legal. And as well as banking, they're working heavily on the banking with the Safe Banking Act. They're also, something very interesting is many think that when and if it becomes legal in the United States, that it will be strictly within the United States and there won't be any cross-border. But I think it's going to mimic the alcohol and tobacco, and I think it'll be just worldwide, wherever it's legal, worldwide. And part of that has been brought out. There's 3 acts in Congress right now. One's the Safe Banking Act that allows cannabis, that will allow cannabis companies that work with legal states to legally bank and not be worried about the feds shutting them down. The other one is the States Act. I'm going to go to the next one, which I remember, but the MORE Act. MORE Act is very interesting. That has, that's in Congress now. Now the Safe Banking Act passed Congress and now is going to the Senate. The MORE Act is a law they want to bring where if you've been prosecuted for certain amounts of cannabis, that will be expunged. As well as they want to put, this is interesting why I think it would be worldwide, is they want to put a national sales tax on cannabis that comes from outside of the United States. So that would lead me to believe that it's going to be more than a national situation. And this.
That's what it is.
One second, owner. The States Act is an act that allows investors, banks, and lenders to feel comfortable dealing financially with cannabis in states that are legal. Because right now, ultimately, it's not federally legal and bad things, in theory, could happen. That answers, Neil?
Yes, sir.
Yes, owner. Did you say something?
What if and when China gets involved, what do you think will happen?
Well, interesting you say that.
It's going to go downhill very fast, I think.
What will happen?
The cannabis profitability.
I think cannabis has a lot of concerns profitability-wise because of, like any product, commoditization. I'm not familiar with China getting involved. I think if the world got involved, it's just major positive for the industry.
China is the origins of pot. The British got them involved in it. 19th century, early last century.
I wasn't around.
Pot
I would think worldwide
business goes back to China.
I don't know. I think worldwide legalization would be very positive for any cannabis investor. I don't know what that means.
Just wait and see.
Okay. Yes, Matt?
I have a question about Afria. Afria, I believe, correct me if I'm wrong, it was a Canadian exchange company and went to the NASDAQ and got torn apart by short polar and everything.
By what?
It got attacked by like short pollers
Right,
and
right,
and
right.
everything. The average share cost at like $4.38, I believe it is, $4.50, something like that. That stock went up to like $11, $12 a share. It was previously at 16 before it started going on the NASDAQ. Why not sell that when that went up over 100%? Is that just not the share cost, to be satisfied with, because the market's still in its infancy, like the fear of owning that company any further after it went up so much?
We would consider selling Afria at 13. I don't remember if it went 10 in our ownership. Remember, we bought it, you're saying our average cost, is that what it says in
It's
there?
like $4.38.
Sure. Yes, that kind of rings a bell.
Yeah.
I don't remember if it went to 10 since our ownership. It very well might have. But I would consider selling it at 13. And then once again, consider. So very often it could go to 14. I'm still not going to sell it, but at least I start looking at it. But we don't look at, we look at what we think the value of the company is and what can happen. And remember, we bought Afria after the fraud was alleged.
Yeah, it was attacked. It was after.
Yeah, and I believe part of the, I don't know if there's fraud, but certainly concerning business practices, but I believe their loss of market cap far exceeded the value of the company. So I thought buying it at 436 was a good thing, and now it's around 5, but it certainly was higher. But once again, since March, the whole industry is down like 55, 60%.
Yeah. No.
So it's, so that would lead right into more of an industry correction.
Okay.
Why is it down so much? I mean, the industry.
There's a lot of things going on in the industry. One, we've been investing in cannabis since 2014. We bought the largest company called Canopy Growth. It was formerly Tweed. We bought that at $1 something a share, our average cost, and we ended up finally selling it all at 33. It went to 50-ish, and now it's in the low 20s. It really probably right around 20. Our annualized return on cannabis since we've owned it is probably around 8.25%. Not a bad return. What's happened in the last 6 months? Well, one you never know, 6 months, who the heck knows? But what I think it's a culmination of things. The Afria fraud, which was more like a year ago. You had the CanTrust fraud. You have what's happening is you're having a huge black market is getting in the way of legal cannabis, and that's really hard to think about. I mean, imagine you could buy, instead of buying a Coca-Cola for 70 cents, you could buy the same thing for 20 cents because it's illegal. It's kind of weird. So they're going to have to get rid of that. So I think part of the decimation has been the fraud at CanTrust. Now we have the vaping crisis on our hands, and let's see how that works out. I do believe, well, we don't know, and who the heck knows, but they think they've isolated the strain to a black market, even though some of it was sold in legal retail in Oregon. But I think that has certainly put some difficulty in the industry. You're seeing a company we own, Hexo, today announced elimination of 20 or 25% of their staff. I showed Kim the other day, because our son almost worked there, Pax Labs, 25% layoff. There's layoffs throughout the industry, and a lot of it is, one, it's their revenues are going slower than anticipated. Part of that is black market, part of that is lack of production. There's so much involved there. And I think there's been a big concern of overvaluation and companies not meeting their targets. You also had a bubble potentially with some conglomerates coming in. Constellation bought about 40%, I think, of Canopy. Imperial Brands, one of the largest tobacco companies, bought 20% of a company we own called Auxly. Now, Auxly, their chairman of the board is one of the founders of Canopy. And that's part of the reason we own it. Who the heck knows? He got thrown out, and Bruce Litton got thrown out, the other CEO of Canopy. Then you also have Altria owns a big part of Kronos Group. And then another company we had, which had the layoffs today, they have a joint venture going on with Molson Coors. And I think people got concerned that because those companies went in, that raised the prices quite a bit, and I think now people are coming down to earth on that. We're seeing funding is getting more difficult for these companies, and a lot of them need funding. If they don't have funding, they're done. I know a company that got funding based on projected revenues of $10 million in 2019, and they ended up with $6 million in 2019. That's not going to go well for when you need more funding. That's not going to be shareholder friendly to the next. We don't own this company, but that won't be shareholder friendly. You also have what's called Cannabis 2.0 in Canada. And like I said, Canada just last week allowed for edibles and extracts, which become vape or oils and so forth, to be allowed. There was concern that was going to be delayed, and there's still concern that even though it didn't get delayed, that the licensing will be delayed. So that it'll take a little bit longer for product to come out. Now, part of that is a blood in the street scenario for us. And the last thing would be commoditization. Prices just going down. There's a picture, Kim and I went and visited my son who used to work in a vertically integrated cannabis company in Oregon, and we're each holding, three of us are in a picture holding 2 pounds each of marijuana. Now, in its day, 5 years ago, that was selling for probably about $35,000. Probably a year ago, and I understand it's gone up since, that same 6 pounds, they might have had trouble selling it for $3,000. A lot of it's commoditizing. So getting back to Canada, now blood in the street scenario. If there's worldwide legalization, or even legalization in North America, Canada, US, and Mexico, that's a lot of users, a lot of revenues. I really could care less if it's delayed 6 months or 2 years. It's just irrelevant to me. We're there for the long term. That's why I'm just shocked. CanTrust. Why the heck did they play with a few $1 million when they were projecting $500 million in revenues? Makes no sense to me. But that's stupidity, hubris, etc. But I think that's the reason they've gotten hit. And I think there's still going to be a big shakeout. Look, if I thought it was a no-brainer, we'd own a lot more than we own. And at September 30th, we owned 10% of cannabis. Now we probably own 8.5%, 9% because we sold off. Part of our numbers were inflated a little bit because of our tax loss selling that we planned for. But if we were really confident that Afria was going to succeed, we would own more than our 0.5% position. But we're not real confident in that. But one day we might become. And they're an interesting company, well-funded, lots of revenues. They're and run by Irwin Simon, who's, Hain Food Group went from nothing to a huge conglomerate. Other questions? That's it. Well, thank you so much. We really Oh, yes, I'm sorry, yes, sir.
That's all right. So, do you think that the re-election of Justin Trudeau has any impact, one would hope positively, to what's happened in Canada and that particular sector?
No, because
Why not?
they legalize it under Trudeau,
I
and it
understand,
just continues.
but he is also, in certain parts of that country, woefully unpopular.
Well, that's, I was talking about the RT the other day, and they were saying how they worded it as such, like, the wording was, he doesn't have the great popularity, he certainly have the vote, but the parties have, you know, like, it's not a majority party at all. I think Canada is way too far ahead of itself. Nothing's going to disturb it. And even if he lost the election, I don't think it would have been disturbed. It's going to stay legal. Cannabis 2.0, the law went through. They've awarded the first license today, I believe. So I don't think that matters that much. But he is president. And we'll see how that goes. But I don't think one person can stop an industry like that, an important industry in Canada. Even Buttigieg was in a dispensary in Indiana, and he was shocked. He said he just thought he'd be going to like this crazy store, and he said he felt like he was in an Apple store, and he was very impressed. And they go, if you were president, will you legalize it? He's like, we'll certainly be looking at it and put it through votes. I certainly wouldn't do an executive mandate. I think it's too important to do that, but I think it's on its way to. It's a different day today. So. I was going to say something. Oh, it's funny because we were in Vancouver, Kim and my family, and we wanted to go to a dispensary. I wanted to see Supreme's product, which is I think called Fire, and so I wanted to see our products in real time. So we were in a restaurant, and they go, oh, well, there's several dispensaries. The closest one is here, but watch out where you're walking. It's a little tough. I'm like, come on, Vancouver. We walked, I swear to God, it was like, we walked, it was crazy. It was like being in an Escape from New York. Remember that movie? This was crazy. Then we get into the place, and I'm like, oh, it wasn't this Apple store. It was like bulletproof windows, and you could look at a menu, and then they'd give it through. Oh, we got out of there quick. But then, sure enough, we went to a store, and they very are much like Apple stores, well educated. Nice stores, informative, so anyway.
Thank you.
Sure. Other questions? Yes, Araceli?
Yes, you mentioned
Ari.
earlier,
Sassy?
thank you for remembering this. You mentioned earlier, like several things ago, that you are interested in buying more pharma. I would want to know your thoughts as to how you plan to incorporate your being a socially responsible investor while adding more to your portfolio with one of you.
Well, like I said, social responsibility is subjective. I don't see how one can consider, now forget about opioids, because perhaps cannabis is a nice alternative to opioids. But why would pharma be socially irresponsible? We have a company that's trying to deal with cystic fibrosis. You have AbbVie, big in Parkinson's. You have a lot of diseases that are looking to be attacked by pharma. So I don't see the social irresponsibility there.
No, I know that there's a lot of good farmers out there. I'm asking what are you going to be looking for to stay socially responsible?
My social responsibility credo is not necessarily competent. It's very subjective. 15% of our portfolio is in Russia. It's not, many wouldn't deem that socially responsible. But when we own the Mercks or the Pfizers or the AbbVies or the, I could say OPCO, which is a real dog so far, but a lot of the companies, the Bristol Myers, I don't see how there's any lack of social responsibility there one bit. I just don't see it. Perhaps if there's and same thing with Johnson & Johnson, but there are sectors, I guess a big opioid manufacturer, it'll be concerning. But I think in general, I guess I go against the grain there that I don't find the social irresponsibility. But I don't know if that answers your question, but, other questions?
Do you have any opinion on like some of these streaming companies, streaming wars?
No.
Okay.
No. It's interesting, Disney,
Disney, Apple.
Disney,
Roku.
has Disney even announced what they're gonna stream? That's gonna be interesting. And Verizon, people who use the Verizon services will get Disney Plus for a year.
Yeah.
But we don't own any of the streamers.
Yeah.
One of my biggest, you look back and say, oh, I wish I did this. I've been using Netflix since day one.
Right.
I should have owned it, but I don't.
Yeah.
But now I'd probably be concerned, because there's a lot of competition out there.
Yeah.
But it's still, I find it to be the best product on the market. And we stream a lot. We use Hulu, Amazon Prime.
Uh-huh.
What's that other one we use? Funny, Tom. Any other jokes? You're a real gem. We discussed movie. I have can't trust and movie ass. Sorry for the joke. That's my.
So what do you think about investing for the election cycle for next year?
No, I think no, none whatsoever.
Yeah.
No, I think that's noise, and
Yeah.
I think it's somewhat irrelevant to investing.
You stay the course.
I don't know. I've never seen an election that made me say like, oh, you shouldn't be involved. But
Yeah.
who knows? A lot of that's noise. I think America will be here a long time as a democracy, as a capitalist country, and I don't know. Yes, Chris.
I had a question I just want to throw out there now because it just got me thinking. Talking about election cycles, I had a chance to go up to, I think it was Oradell, and I actually met and sat in a room with Yale Hirsch. And you may know he wrote the Stocktraders Almanac.
Okay.
What do you? And it was an amazing, because I was a younger guy and I'm sitting in a conference room with him. What do you think about there's like something like that as a reference for? Or do you think it doesn't really matter?
I'm not familiar with Stocktraders Almanac.
Yeah, oh, you've never heard of it?
I've heard of it, but I'm not familiar. I've looked at it. I'm into pure fundamental analysis. Right. A company like Gazprom, they're going to earn, I'm rounding, they're going to earn $2 a share this year. They probably will. They pay a 7% dividend, and now they're well up from even in a few weeks.
Yeah, up another $1 since you reported this.
It's up almost $1 since September, but they're still selling at a PE of less than 4. That's pretty darn cheap for a healthy company. That company is rated AAA by two international rating agencies. We have them much lower, but they were recently upgraded. So, and put that in perspective, if Exxon was trading at the same PE, they wouldn't be selling for $70 a share. They'd be in their teens, early teens. So, I really go by fundamental analysis and how much are you willing to pay for a future return on investment. Others? Well, we do have the room till 10, and I'm going to have a drink or two, and I really thank you for coming. It's such a pleasure to have you guys, and thank you. You can always call or email me, and I'll try to answer any questions.